At its narrowest point, it's just 21 nautical miles wide. A sliver of water between Iran and Oman called the Strait of Hormuz, and for decades, roughly a fifth of everything the world burns for fuel has had to pass through it. In the spring of 2026, that sliver of water closed, and thousands of miles away, in a grocery store parking lot in Ohio or a gas station in Georgia, ordinary Americans felt it within weeks. This is a story about two narrow points that turned out to be connected: a 21-mile-wide waterway on the other side of the planet, and the shrinking amount of breathing room in the average American household budget. Over the next 20 minutes, I'll walk you through exactly how they're linked and why, even before this year's shock, the story of American inflation was already 5 years in the making. Let's start with the through line that runs underneath everything else in this video. The Federal Reserve has one official inflation target, 2% a year, measured by its preferred gauge, the Personal Consumption Expenditures Price Index, or PCE. Since March 2021, the US has not hit that target. Not once. Not for a single month. That streak, missing the Fed's own goal for 5 years running, is now one of the longest in the modern history of the Federal Reserve, stretching across the final years of Jerome Powell's tenure as Fed chair and now into the tenure of his successor. For a while, in 2023 and 2024, that gap was narrowing. Inflation had cooled sharply from its 2022 peak when it topped 9% at its worst, the highest reading in 4 decades, driven by a mix of pandemic-era stimulus, supply chain chaos, and Russia's invasion of Ukraine. The Fed responded with one of the most aggressive rate-hiking campaigns in its history, and by 2023 and 2024, inflation had fallen substantially from that peak, even as it remained stubbornly above the 2% goal. Economists were cautiously optimistic that the last stretch back to 2% would simply take patience. Then came 2026, and instead of closing that final gap, it blew back open. On the 28th of February 2026, the United States and Israel launched coordinated airstrikes against Iran under an operation targeting military and nuclear facilities, strikes that, among other things, killed Iran's supreme leader. Iran responded with missile attacks on Israeli cities and US bases across the Gulf. Within days, the conflict had expanded into Lebanon as well. On the 4th of March 2026, Iranian forces declared the Strait of Hormuz closed and began carrying out actual attacks on commercial ships attempting to pass through it, boarding vessels, threatening tankers, and laying sea mines. The International Energy Agency would later call it the largest supply disruption in the history of the global oil market. Its director went further, describing it as the greatest global energy security challenge the world had ever faced. The numbers behind that statement are staggering. Before the war, roughly a quarter of the world's seaborne oil trade and a fifth of its liquefied natural gas passed through that single 21-mile channel. Within days of the closure, tanker traffic through the strait dropped to almost nothing. By late April, an estimated 20,000 sailors and 2,000 ships were stranded in the Persian Gulf, unable to move. Oil prices reacted immediately. Brent crude, the international benchmark, surged more than 10% to around $80 to $82 a barrel within days. As the conflict dragged on, U.S. officials and Wall Street analysts openly discussed the possibility of oil spiking toward $200 a barrel if the strait stayed closed for good. At the worst point of the war, prices did approach $120. A ceasefire between the US and Iran was announced on April 8, and prices retreated. But, as we'll see later in this video, ceasefire turned out to be a fragile word. The disruption wasn't limited to oil. The Strait of Hormuz also carries a large share of the world's liquefied natural gas, and, unlike oil, there's no meaningful stockpile or alternate route to fall back on. Qatar, one of the world's largest LNG exporters, declared force majeure on its supply contracts and began winding down liquefaction operations entirely, warning it could take weeks to restart, even once shipping resumed. Parts of the country's largest LNG facility later sustained missile damage that its operator said would take up to 5 years to fully repair. 15,000 cruise ship passengers found themselves stranded when operators halted Persian Gulf itineraries altogether. And Europe, which draws a meaningful share of its own gas from the region, began bracing for a winter energy crunch, reminiscent of the one that followed Russia's invasion of Ukraine in 2022, this time arriving on top of already historically low gas storage levels across the continent. Here's the mechanism that connects a naval blockade near Iran to your wallet. Oil is a globally traded commodity, and gasoline is refined from it. When roughly a fifth of the world's oil supply suddenly can't move, the price of what remains goes up everywhere at once, including at gas stations that have never bought a single barrel from the Persian Gulf. According to the Urban Institute's American Affordability Tracker, the U.S. national average price of gasoline rose by a full $1 per gallon in the weeks after the strait closed in late February 2026. By the 10th of June 2026, AAA had the national average at $4.15 a gallon, up from $3.12 the same time the year before. That single number rippled through the entire consumer price index. According to the Bureau of Labor Statistics, overall U.S. energy costs were up 23.5% year-over-year by May 2026. Gasoline specifically was up 40.5%. Home heating oil was up an even more staggering 58.9%. And energy doesn't stay contained to energy. It's an input cost for trucking, farming, manufacturing, and nearly everything that eventually shows up on a store shelf. The US actually fared better than much of the world in this respect. Because America is less dependent on Hormuz shipments than Asian buyers, and is itself the world's largest LNG exporter with a relatively insulated domestic gas market, industry analysts expected the US to be among the last major economies to feel the full brunt of the shock. Other countries weren't so fortunate. Slovenia introduced fuel rationing. A British supermarket chain warned of fuel shortages at its pumps, and protesters in the UK called for a fuel price cap after slow-moving convoys caused delays. Seen in that light, America's inflation numbers, painful as they've been, represent the shock arriving in a comparatively cushioned form, which makes it all the more notable how sharply it still showed up in the data. By May 2026, the damage was visible in the official data. Headline CPI inflation came in at 4.2% year-over-year, the highest reading in 3 years, and a full 1.8 percentage points higher than the 2.4% recorded back in January, before the war began. The Fed's preferred gauge, PCE inflation, told a similar story. 4.1% year-over-year in May, the highest since April 2023. Core PCE, which strips out food and energy to capture the underlying trend, hit 3.4%, the highest reading since October 2023. That core number matters enormously, because it's supposed to be the measure least affected by a temporary oil shock. When core inflation climbs too, it's a signal that price pressures are broadening out beyond just the gas pump into the kinds of goods and services that don't reverse themselves the moment a war ends. The Fed's response at its June 16–17, 2026 meeting was unusually blunt. Policymakers held interest rates steady at a range of 3.5% to 3.75%. But in their official statement, they adopted language explicitly promising to deliver price stability, a notably firm phrase after missing their 2% target for 5 consecutive years. They also removed a previously signaled rate cut for later in the year and opened the door to something markets hadn't seriously priced in for months, an interest rate hike. As of early July, traders were pricing in real odds of a hike as soon as September 2026. This entire inflation flare-up landed on the desk of someone brand new to the job. Kevin Warsh officially became the Fed's chair on the 22nd of May 2026, succeeding Jerome Powell, whose term had run since 2018. June's meeting produced the first summary of economic projections under Warsh's leadership, the quarterly document where Fed policymakers lay out where they expect inflation, growth, and unemployment to head. The revisions told their own story. The median projection for core PCE inflation at the end of 2026 was revised sharply upward from 2.7% to 3.3%. The projection for the end of 2027 moved up too, from 2.2% to 2.5%. In plain terms, the people setting U.S. monetary policy now. Expect this inflation problem to stick around considerably longer than they thought just 3 months earlier. For a new Fed chair, that's about as difficult an inheritance as it gets an inflation target missed for half a decade, a fresh energy shock layered on top, and a labor market, as we've covered in a previous video on this channel, that's already showing real signs of strain. Energy is the headline-grabbing piece of this story, but it isn't the only one, and it's worth understanding why some of the underlying inflation was never going away quickly. War or no war. Housing costs move through the official inflation data very slowly. Because leases typically reset only once a year, and the government's data collection captures a wide mix of both new and existing rental agreements, shifts in the housing market take months, sometimes years, to fully show up in the Consumer Price Index, and just as long to fade back out. In May 2026, the Shelter Index rose 3.4% year over year, a slow-moving but persistent source of pressure that has helped keep core inflation elevated since well before this year's oil shock. Food tells a similarly layered story. Grocery trips remain, according to Brookings, the place where most Americans get their most regular and vivid sense of what inflation is actually doing to their lives, because, unlike a mortgage payment, you're standing in the checkout line seeing the total in real time, multiple times a week. Electricity adds another slow-building layer. According to the Urban Institute, residential electricity costs have climbed faster than earnings across much of the country, leaving customers paying roughly $40 more per month on average in December 2025 than they were back in December 2017. Part of that increase traces back to the enormous electricity demands of new AI data centers, which has made rising household power bills a politically sensitive issue in communities that host them. And mortgage rates, though outside the scope of the CPI itself, compound the same squeeze. Most surveyed homeowners say rates would need to fall to 5% or lower before they'd even consider buying another home, a level few forecasters currently expect anytime soon. This is where the story stops being about abstract percentage points and starts being about specific bills landing in specific mailboxes. Start with health insurance. According to Brookings, employer-sponsored health insurance premiums have risen 342% since a pre-2000 baseline, more than 5 times the pace of economy-wide inflation over the same stretch. More recently, out-of-pocket health expenses per person rose from $1,239 to $1,652 in just 5 years, a jump of nearly a third. It's little surprise that in an April 2026 Gallup survey, 32% of Americans said they were very worried about healthcare costs, the single highest-ranked worry on the list, ahead of groceries at 24%, rent or mortgage payments at 23%, utilities at 22%, and gas at 17%. Auto costs tell an equally stark story. Since the pandemic began, the average price of a new car has climbed from $38,000 to $50,000, a 32% increase. Used car prices, once considered the budget-friendly alternative, are up 28%, and auto insurance premiums specifically have risen a striking 55% over the same period, according to Brookings analysis. Home insurance has followed its own steep climb. According to Insurify's 2026 Insuring the American Homeowner Report, the national average annual home insurance premium is projected to break $3,000 for the first time in 2026, up from $2,948 at the end of 2025. That leaves the typical homeowner paying roughly $900 more a year than they were paying back in 2021. In some states, the increases have been dramatically steeper. Colorado's average premium jumped 33% in a single year, Minnesota's climbed 34%, and Nebraska's rose 25% after already spiking the year before. 1 in 4 homeowners surveyed said they'd drop their home insurance entirely if their mortgage lender allowed it. Much of that pressure traces back to climate risk, rather than the Iran war at all, a reminder that America's affordability squeeze has several independent sources feeding it at once. Insurers have faced a mounting wave of claims from hurricanes, wildfires, floods, and severe hail. And according to the Consumer Federation of America, average home insurance premiums rose 24% between 2021 and 2024 alone, outpacing general inflation by 11 percentage points over that stretch. Nearly all homeowners surveyed by one industry report said they now expect extreme weather to damage their home within the next 3 years, and roughly a third say they aren't confident they'll be able to maintain adequate coverage through 2026 at all. Childcare has also outpaced overall prices. Between 2020 and 2024, average childcare costs rose 29%, 7 percentage points faster than overall inflation over the same stretch. And starting in mid-2024, the pace of childcare inflation accelerated to roughly twice the overall rate, a trend that continued through 2025. Add it all up, and you get a pattern where wages have genuinely grown average. Hourly earnings are up roughly 30.8% since the pandemic began, but the specific costs families can't easily avoid have, in many cases, grown even faster. That's the mathematical definition of a shrinking sense of financial breathing room, even in a technical expansion. The survey data on how Americans feel about all this is about as one-sided as public opinion polling ever gets. A Harris poll conducted for The Guardian found that 95% of U.S. adults believe the country is facing an affordability crisis, and that poll was taken before the most recent flare-up in the Iran conflict in early July 2026, which is likely to have pushed sentiment even lower. In the same survey, 57% said they believe the overall economy is getting worse, a more than 20 percentage point jump from before the war began in February. Gallup's tracking tells a similarly bleak story. In April, Doami Doazit Shishase, a record 55% of Americans said their personal financial situation was getting worse, the 5th consecutive year that a larger share of the country has said things are worsening rather than improving. Gallup notes the only comparable multi-year stretch of sustained financial pessimism in their tracking was during the Great Recession. The organization's broader economic confidence index fell 11 points in a single month, to -38. What's notable is how bipartisan this anxiety is. Roughly half of Democrats, Republicans, and Independents alike told pollsters they've personally struggled to afford necessities like gas and food in recent months. Affordability, in other words, isn't a story confined to one political tribe's talking points. It's showing up in nearly everyone's grocery receipts and gas station visits, regardless of who they voted for. Beneath the immediate cost worries, Gallup also found something a little more structural. Majorities of Americans say they worry about not having enough money for retirement, 62%, and about being unable to cover medical costs from a serious accident or illness, 60%, while 59% say their taxes are too high, near a record low in Gallup's decades of tracking that particular question. Taken together, these numbers describe a public that isn't just annoyed about a temporary gas price spike, it's genuinely uncertain about its longer-term financial footing, which is a much harder mood for policymakers to reverse quickly. Here's where this story gets genuinely uncertain, because it's still unfolding as this video is being made. After the April 8 ceasefire, oil prices did retreat substantially, easing back towards $70 a barrel by early July, but shipping traffic through the strait never fully returned to pre-war levels, as Iran continued asserting informal control over passage through its waters. Then, in the first week of July 2026, the fragile truce cracked. The U.S. carried out fresh strikes on Iran in response to attacks on commercial ships near the strait, and President Trump publicly declared the ceasefire over, while also revoking a waiver that had allowed limited purchases of Iranian oil. Oil prices jumped again within a day, with Brent crude settling more than 3% higher. Energy analysts describe the current situation as a risk premium now permanently priced into oil markets, not necessarily a return to the worst days of the war, but a persistent uncertainty that keeps prices higher than they'd otherwise be, and that could spike again with very little warning. As one commodities strategist put it, the pre-war status quo, where Iran had essentially no leverage over the strait, is probably gone for good. Iran has demonstrated it can meaningfully disrupt this choke point, and markets now have to price that risk in permanently, not just during active fighting. Before closing, it's worth resisting the pull toward pure alarm, because the full picture has some genuinely stabilizing forces in it too. Oil prices, even after the renewed tensions in July, remain well below their wartime peak, near $120 a barrel. The worst-case scenarios that traders and officials openly discussed in March and April haven't materialized. Saudi Arabia and the UAE have rerouted meaningful volumes of oil through pipelines that bypass the strait entirely, and the US. And other governments coordinated a record release of strategic oil reserves to cushion the shock, with the US Energy Secretary indicating a release potentially as large as 3 million barrels a day. Both moves have measurably softened what could have been an even sharper spike. There's a financial silver lining buried in the disruption too, at least for some. An analysis by the New York Times found that in the period between the war's start and early May 2026, the biggest beneficiaries of the reshuffled oil trade were the United States itself, which saw roughly $50 billion in additional export revenue, and Russia, which added more than $15 billion. American energy producers, in other words, have captured real upside, even as American consumers absorbed higher prices, a reminder that the economy rarely moves in one direction for everyone at once. There's also a case for genuine optimism about the underlying non-war inflation trend. As recently as January 2026, before the conflict began, headline CPI was running at just 2.4%, within reach of the Fed's target for the first time in years. That suggests the sticky component of America's 5-year inflation streak had genuinely been easing, and that this year's spike, however painful, is layered on top of an economy that was closer to healthy than the current headlines suggest. If the ceasefire holds and shipping through the strait genuinely normalizes, several economists interviewed by major outlets expect energy-driven inflation to fade within a couple of quarters, even if the affordability pressures on housing, healthcare, and insurance take considerably longer to ease. Bring this all together, and you get a picture of an economy caught between two different clocks. One clock is fast, oil and gas prices that can spike or retreat within days, based on headlines from a war zone 7,000 miles away. The other clock is slow, health insurance, childcare, home insurance, and housing costs that have been climbing steadily for years and won't reverse just because a ceasefire holds. For the Fed, that combination is exactly what makes policy so difficult right now. Raise rates too aggressively to fight an oil-driven spike, and you risk deepening the labor market weakness already showing up elsewhere in the economy. Hold rates too loose, and a persistent broadening inflation problem that's already run 5 years past target could become even more entrenched in the psychology of consumers and businesses alike. For everyone else, the practical reality is simpler and considerably less abstract. The money in your paycheck has to stretch across a growing list of bills that are rising faster than that paycheck is. That gap, not any single headline number, is what 95% of Americans are describing when they say they're living through an affordability crisis. Return for a moment to that 21-mile strip of water where we began. It's easy to think of a strait on the other side of the world as somebody else's problem, a headline you scroll past on the way to something more immediately relevant to your life. But 2026 made the connection impossible to ignore. A closure at the narrowest point on a map became, within weeks, a squeeze at the narrowest point in millions of American budgets. Both kinds of narrow passages are now being watched closely by people who never expected to care about a strait near Iran, central bankers setting interest rates, and families deciding whether they can afford to fill up the tank this week. 5 years past target and counting. The real question isn't whether this particular flare-up eventually fades. Most economists think it will. It's whether, by the time it does, American households will have caught up, or whether the gap between their paychecks and their bills will simply keep finding a new narrowest point to squeeze through. What's been hitting your own budget hardest this year? Gas, groceries, insurance, or something else entirely? Tell me in the comments, and subscribe for more stories about the numbers behind the headlines.